Welcome back to the Deep Dive. We are broadcasting to you from early March 2026. And I have to be completely honest with you today.
Uh-oh.
Yeah, I pulled up my portfolio this morning, specifically, the crypto slice of the pie. And I had this sudden, overwhelming urge to just shut the laptop and go for a very long walk.
Oh, yeah. You and everybody else.
Right. If you've been watching the charts lately, you know exactly what I'm talking about. It's chilly out there.
Chilly is putting it mildly. I think for a lot of people, specifically those who've been holding on for the last year or two, hypothermia might be the better medical term at this point.
Yeah, hypothermia is right. It's brutal.
It really is.
And today we are doing a deep dive specifically into the state of XRP and the broader crypto market. But look, I don't want to just sit here and read ticker symbols to you.
No, anyone can check their phone for that.
Exactly. You can get that on your phone. We have a very specific mission today. We are trying to solve a mystery here. Because on paper, if you look at the headlines, the current administration, the tech adoption, everything, should be screaming bull market.
It really should.
And yet, XRP is facing this crypto winter that feels, colder than anything we've seen in a long time. Meanwhile, other traditional assets are just absolutely tearing the roof off.
That's the disconnect. That is exactly what's driving people crazy right now. If you rewind to, say, early 2025, the narrative was completely set.
Yeah.
We had all this bullish momentum.
Right.
We had the political winds finally shifting in favor of the industry. And then we crossed into late 2025 and early 2026, and the floor just fell out.
So if you were sitting there holding a bag of XRP, and you're wondering why the so-called digital revolution feels like it just hit a brick wall, this is the deep dive for you.
Yep.
We've got sources pointing to 3 specific catalysts today. And honestly, they're the usual suspects.
No SEC lawsuits this time.
Right. No lawsuits, no massive exchange hacks. It's about a fundamental shift in the actual global financial architecture.
It's structural. And I think that's the scary part for a lot of investors. We aren't just looking at a bad news cycle or a temporary dip. We are looking at a complete repricing of what crypto actually is.
Compared to what?
Compared to gold, compared to stablecoins, and especially compared to the Federal Reserve's new playbook.
Okay, before we get to the why, though, we do have to face the what. And I'm going to play the bad guy here and just read the cold, hard numbers.
Let's hear the damage report.
Okay, it is early March 2026. Give us the context.
Well, brace yourself. Year to date. So we are talking just the first 8 or 9 weeks of 2026 XRP is down 26%.
Wow.
Yeah. That is a quarter of your position's value just evaporated in less time than a single fiscal quarter.
That is a gut punch. But look, crypto is volatile, right? I mean, we've seen 20% swings in a weekend before. Is this really that different from standard crypto volatility?
If it were just a flash crash, I'd say, yeah, totally ignore it, just noise. But you have to zoom out. Over the last 12 months, XRP is down roughly 41%.
41%.
That is a sustained bleed. We aren't talking about a sudden dip that gets bought up immediately. We are talking about a year-long trend of lower highs and lower lows.
And price-wise, just to anchor us, we're sitting right around $1.75 as of this recording, which is down another, 5 cents today?
Yeah, about 3.4% on the day. And $1.35 might sound okay if you were buying back in 2017 or early 2020.
Sure.
But the 52-week high was $3.65.
Oh, man.
So you have all these people who bought in at $3, $3.50, totally convinced we were going to break past all-time highs, and they are now sitting on a 60+% drawdown.
That just destroys confidence.
Completely destroys it.
And it destroys portfolios.
Yeah.
And to be fair, looking at the sources, it's not just XRP. I'm looking at Bitcoin, sitting at about 65,600 right now.
Right.
Ethereum is under 2,000 again, trading right around 1936. So the heavy hitters are all bleeding out.
It's an industry-wide chill.
But here's my question for you. We have seen crypto winters before. We lived through 2018. We lived through 2022. Usually the maxim everybody repeats is zoom out when in doubt.
Right, just hold on.
Yeah, just hold. Why are our sources suggesting this time is fundamentally different? Why isn't this just another obvious buying opportunity?
Because in previous cycles, everything tended to fall together. Stocks fell, crypto fell, maybe gold stayed flat or dipped a bit. It was usually a liquidity crunch across the entire board.
Okay.
What's happening right now in March 2026 is a massive divergence. And that brings us perfectly to catalyst number 1. We are witnessing the death of a narrative that has practically held this entire market up for a decade.
You're talking about the digital gold narrative.
Exactly. For years, the main sales pitch, the reason institutional money was supposed to flood in, was this idea of a hedge. The pitch was, when the fiat system gets shaky, when inflation scares people, you buy Bitcoin and you buy XRP because they are hard assets.
Right. They're mathematically scarce. They are the new gold.
That was the brochure. Store of value.
Yeah, that was line 1 on the brochure.
Well, the market is currently calling that bluff. Catalyst number 1 is the massive resurgence of precious metals. Because while crypto is down 41% over the year, gold and silver are running red hot.
They're just breaking out.
Breaking out and hitting new levels.
Which has to be so frustrating if you're a crypto holder. You have these boomer rocks, literally just tangible metal bars sitting in a vault, and they are massively outperforming this cutting-edge, decentralized financial tech. Why is that happening right now?
It comes down to a flight to quality versus a flight to risk. See, in a high-anxiety macroeconomic environment, which we are absolutely in globally right now, big money doesn't want code.
They want collateral.
Exactly. They want something with zero counterparty risk, something physical. And despite all the progress we've seen, crypto is still viewed fundamentally as a risk-on asset. It behaves way more like a speculative tech stock than it does like a gold bar.
So when the heat gets turned up and people are scared, investors aren't looking for a 100x return. They're just looking for capital preservation.
Yes.
And they are collectively deciding that XRP isn't where you park your money to keep it safe.
Precisely. And that pokes a really massive hole in the whole institutional adoption thesis.
Yeah.
If hedge funds and sovereign wealth funds are scared and they choose physical gold over crypto, that huge wall of money we were promised for years.
It's not coming.
It's not coming, at least not right now. The sources note that investors are seeking greener pastures, and right now, those pastures are literally gold-plated.
Okay, so the store of value argument is taking an absolute beating.
Yeah.
But let me push back here as a hypothetical XRP holder.
Go for it.
I'd say, fine, maybe it's not gold. But it's not supposed to be gold. It's a utility token. It's meant to move money. It's a bridge currency. So as long as people and banks are using the network, the value of the token should go up, right?
That is the logical assumption. That's the utility argument. But that leads us directly into catalyst number 2. And I actually think this one is far more dangerous for XRP specifically than the gold situation.
And this is the stablecoin takeover we saw in the research.
Yes, the rise of stablecoins. And we need to really unpack what this means technically for the market. We are seeing a massive, massive proliferation of stablecoins. These are tokens pegged exactly 1-to-1 with the US dollar.
Right.
And their adoption is just skyrocketing while the rest of the market crashes.
I mean, isn't that generally good for crypto? If people are using stablecoins, they are still on the blockchain. They're using the rails. Shouldn't that adoption lift the whole ecosystem?
It lifts the infrastructure, sure, but it kills the token value. Think about the velocity of money. If I want to send you $10,000 across the world, and I use a stablecoin like USDC, I am using the blockchain, yes, but I am not buying and holding a volatile asset. I'm literally just moving digital dollars.
So I'm not creating any actual demand for XRP on the open market. I'm just using the highway without having to buy the specific card they're selling.
Exactly. And it's worse for XRP because XRP's main value proposition for years was cross-border payments.
Right, the bridge currency.
Exactly. It was supposed to be the bridge asset between two different fiat currencies. But if stablecoins are liquid enough globally and trusted enough by institutions, you don't actually need a volatile bridge asset. You just swap dollar to stablecoin to euro. The middleman token XRP gets completely cut out of the loop.
That is a really critical distinction because we used to think that sheer volume on the chain automatically equaled value for the token. But if that volume is all denominated in stable assets pegged to fiat, the speculative premium on XRP just evaporates.
It's what I call the boring winner syndrome. People, and businesses especially, they absolutely hate volatility.
Yeah.
If a business can settle a $1 million transaction in a digital token that doesn't fluctuate 3% while they're eating lunch, they will choose that every single time over XRP.
Right. It's like showing up to pay for your groceries with a stock certificate that's violently changing value while you're standing in line versus just handing the cashier cash.
Perfect analogy. Stablecoins are the digital cash. They're boring, but they work. XRP is becoming the volatile stock certificate, and the broader market is just voting with its wallet right now. For actual utility, cash is still king.
Man. So we've got gold stealing the safety use case from crypto. We've got stablecoin stealing the payment use case. That is a rough 1-2 punch.
It really is.
But there's a third factor here in our sources, and this one I have to is the most confusing to me because it heavily involves politics.
Yes. Catalyst number 3, the political curveball.
Right. So to set the stage, we are in the second term of President Trump. And before we get into this, I want to make a very clear disclaimer to everyone listening.
Good idea.
We are strictly analyzing the financial and market implications from the source material here. We do not take political sides on this deep dive. We're just looking impartially at what the market expected versus what actually happened.
Absolutely. Just following the money.
Exactly. So the consensus view going into 2025, the so-called Trump trade, was supposed to be insanely bullish for crypto. We were talking deregulation, a super pro-business environment, maybe even talks of a strategic Bitcoin reserve. Why hasn't that translated into giant green candles for XRP?
Because at the end of the day, markets don't run on campaign rhetoric, they run on liquidity. And liquidity in the United States is controlled by the Federal Reserve.
And this is where the massive plot twist comes in.
A huge plot twist. President Trump appointed Kevin Warsh to succeed Jerome Powell as Fed chair. Now, if you don't obsessively follow Fed politics, Warsh is a very specific, very traditional type of economist.
He's definitely not a money printer, go Berg kind of guy.
No, he is the exact opposite. He is a known vocal critic of quantitative easing. He fundamentally believes that the Fed has distorted free markets for way too long by keeping money too cheap. He strongly favors sound money.
Now, sound money sounds great in a textbook. It sounds responsible. But what does that actually mean for a highly speculative asset class like crypto?
It means pain, severe pain. Crypto, by its very nature, has historically thrived on excess liquidity. When money is incredibly cheap to borrow and interest rates are near zero, people take risks. They gamble on high-growth tech stocks and volatile crypto tokens.
Because they can't get yield anywhere else.
Right. But when you have a Fed chair like Kevin Warsh, who is decidedly hawkish, meaning he wants to keep rates higher to protect the purchasing power of the dollar, that excess liquidity just dries up, it vanishes.
So all these crypto investors were hoping for this cheerleader Fed chair who would aggressively cut rates and essentially pump their bags. And instead, they got a strict principal who wants to discipline the financial markets.
That's exactly what happened. The transcripts from the recent Fed meetings under Warsh are super telling here. The board is incredibly hesitant to cut rates right now. In fact, some members are even discussing potential hikes if inflation ticks up even a little bit.
Wow.
So this highly anticipated Trump bump completely failed to materialize because the harsh monetary reality of a Warsh Fed is just crushing it.
That is just fascinating irony. You have this famously pro-business president, but he appointed a Fed chair who is effectively, whether intentionally or not, strangling the speculative bubbles.
And you have to understand, Warsh views these asset bubbles like a massive meme coin mania or a sudden crypto run-up as symptoms of an unhealthy economy. He's not sitting there trying to support the price of XRP. He's actively trying to drain the excess cash from the system. And unfortunately for token holders, crypto is the embodiment of that excess cash.
It connects right back to the risk-free rate, doesn't it?
Yep.
If I can get 5% guaranteed return on a U.S. government bond because Warsh is keeping rates high, why on earth would I risk my capital on XRP, which, as we established, is down 41% this year?
You wouldn't. Any rational actor wouldn't. And that's the exact math problem that institutional investors and hedge funds are solving right now. The hurdle rate to justify taking a risk on crypto is just too high.
Okay, so let's summarize where we are. We have a perfect storm. The macro environment under the Fed is hostile, the stablecoin competition is winning the utility war, and the safety trade has completely rotated back to physical gold.
That's bleak.
Which leads us to what the sources call the investor's dilemma. We're looking at XRP sitting at $1.35. For the diehards out there, the XRP army, the immediate instinct is to double down. Buy the dip. Shake out the weak hands.
It's a very powerful psychological instinct. It's human nature to want to average down. Well, we have to look at this coldly and analytically.
Right. And our sources include a recent note from the Motley Fool Stock Advisor team. They just released their 10 best stocks to buy now list. And I'm guessing XRP didn't make the cut.
It wasn't even close to making the cut. And I think this is where we really need to talk about opportunity cost, because that's the silent portfolio killer.
Opportunity cost. This is the concept that honestly hurts the most as an investor. It's not just about the money you lost on a bad trade. It's about the massive gains you didn't make elsewhere because your money was tied up.
Exactly. While an investor is stubbornly holding XRP at $1.35, just waiting and praying for it to get back to $3 just so they can break even,
The rest of the market is moving.
the rest of the market is flying. The AI sector is booming. Biotech is seeing massive breakthroughs. The source material actually lists some really painful historical examples of this. They talk about Netflix in 2004, Nvidia in 2005, Tesla in 2012.
Wow.
These were the legendary 10-baggers, investments that returned 1,000% or more over time.
And every single day, you have your capital tied up in a, well, what looks right now like a zombie token that is actively fighting the Federal Reserve and losing ground to gold. That is a day your capital isn't deployed in the next NVIDIA.
That is the ultimate tragedy of the sunk cost fallacy. Investors convince themselves, I can't sell now, I'm down 40%, I have to wait until I'm back to even.
Yeah.
But the cold truth is, the market does not care what your entry price was. The market has no memory of what you paid. It only cares about where the asset is going tomorrow.
That's a really hard pill to swallow. It requires admitting you were wrong, taking a realized loss, and moving on. And for a community that is as passionate and tight-knit as the XRP community, that feels like straight-up betrayal.
It definitely feels like betrayal to them, but in the world of finance, it's actually just basic risk management. The financial experts in our sources are suggesting that despite this massive dip, XRP just faces way too many structural headwinds right now. Regulatory clarity didn't fix the monetary environment or the stablecoin competition. There are simply better, much easier places to make your money work for you right now.
It really puts the whole HODL mentality to the ultimate test. Holding through a regular crypto winter is one thing. That's just a cycle. But holding through a fundamental regime change in global finance is something else entirely.
And make no mistake, that's exactly what this is, a regime change.
So let's try to synthesize all of this for the listener who is sitting there staring at that red chart right now. We aren't just looking at bad luck or a temporary lull. We are looking at a three-front war.
Right. Let's break it down. Front one is the store of value war. Gold is definitively winning that battle right now because global fear is driving big money to physical assets, not digital ones.
Front two is the medium of exchange war. Stablecoins are absolutely winning that because real-world commerce demands stability, not speculative volatility.
And front three is the liquidity war. The Federal Reserve, under Kevin Warsh, is actively draining the very pool of cheap capital that crypto needs to swim in.
When you lay it out sequentially like that, it is really hard to find the bullish case for the near term. It feels like the market is telling us something very specific, very pointed about the future of this specific asset class.
It is, and I want to leave you and the listeners with a thought that came up while I was going through the research, which I think is really profound. It directly challenges the sort of victim mentality that a lot of crypto folks have adopted over the years.
Oh, let's hear it.
Think about it. We have spent the last 10 years hearing that the only thing holding crypto back from global dominance was the U.S. government. The rallying cry was always, if only we had regulatory clarity, if only the SEC would stop suing us and just let us build.
Right, the whole regulation by enforcement complaint.
Exactly. Well, look around. It's early 2026. We now have a supposedly pro-crypto administration. We essentially have regulatory clarity. You finally have official permission to exist from the powers that be.
And despite all of that, the price is still tanking.
Exactly. So the very uncomfortable question we have to ask is this. Does this mean the broader market is finally realizing that crypto needs a lot more than just permission to exist? It actually needs a reason to exist, a reason that precious metals and stablecoins don't already satisfy better and more efficiently.
Wow, that is heavy. The permission versus purpose gap.
Yeah. If you fight for years to be allowed into the party, but once you get inside, nobody actually wants to talk to you.
Maybe you aren't the life of the party anymore.
Maybe the party has just moved on without you.
Well, on that slightly existential note, we are going to wrap it up for today. Whether you decide to hold the line with your XRP or rotate your portfolio into gold or tech, we really hope this deep dive gave you a much clearer map of the financial battlefield as it stands in March 2026.
Always a pleasure to break it down with you, even when the news is a bit tough to swallow.
Thanks for listening, everyone. Take care of your portfolios, and we'll see you on the next deep dive.